back on here. What a horrible week in the markets. I know a lot of people consider, the sell-off and all that stuff. It's the catalyst was the US numbers, manufacturing. I talked about that in the blog. If you don't read the blog, please do. I won't send an email every time I update it because you get too many emails. But on pretty much barely a days goodbye where I don't update it. So check it out now and again, and you can see my holdings and what's happened. But yeah, American markets, of course, manufacturing in contraction. Then unemployment, they didn't put on as many jobs as expected, 179,000, I think it was for July. And that was a forecast, 114,000 actually was. And it looks now like the US economy is in manufacturing recession. Consumers are still strong, but how long will they be strong for? So a lot of people are saying a recession is nailed on. And in fact, if you look at the yield curve, it pretty much is nailed on. So I think, it's not a negative because I think what the Fed will have to do is reduce interest rates. And American markets have rallied, but it's hard to see if American markets have rallied. The Russell 2000 did start rallying, which is a small cap index. The S&P 500 and NASDAQ is very skewed towards those big AI plays. And so it's hard to see that. But anyway, let's crack on here. But I think it will be, it will have some volatility. And then they'll realize they'll need to reduce interest rates, and that's very good for equities and for gold and hard assets generally. Okay, let me just get rid of this bar. There's a bar in the middle of the screen. Okay. Wednesday weekly webinar, 7th of July, 2024, Q3. Let's start. By the way, the performance tab. Let me just show you this. Let's get rid of this. Toolbars, get rid of those. No shows. So if you click here, MicroCap League, there's a performance tab. You should be seeing this now. Apparently, it was a cache issue. Now, it's still looking through this, but you can see, rather than MicroCap League, you can see the performance of companies. There is a glitch in there with one of them. I think it was a share consolidation, which is Celebris Technologies, which is showing, well, drop down. There we are. So you can, do these by name, but by month, what they've been performing at. So you can have a look at the best performers. For last month, looks like Space and People. Crimson Tide, 3 months, 6 months. Now there is an issue when it gets to 12 months. So Celebris, I think they've had a consolidation. So we put a contact developer, and we're going to be looking at how to manually edit that. Because it has to catch up, but everything else seems okay. Let me know if you see any issues in there. It's basically, originally it was for me, and I was downloading spreadsheets and thinking, right, how can I show the performance? But now you can sort of see them, in the companies. So yeah, so there we are. So it's just maybe a good thing to look at. And obviously you click back up there, so you should be all able to get access to that. Again, be careful as with digital. It's come up with news, and they've said 14 million, I think, EBITDA loss. So that's not going to stay at the top. Anything in red for new members, that means figures are coming out. And so the scores are based on the full year results. So they will be changing as soon as the results come out. If the results aren't as good as last year's, it'll obviously drop on the table. Now, if you look for not a lot of interims or full year results out this week, but if it's in blue, then they've just had results posted. So that's quite a new update. You can rely on those figures because it's the most current set of figures, and the scores attributed to that are accurate. So hopefully that makes sense. Anyway, okay, tonight's topics. My holdings. Well, I've increased my stake in Ramsdens, and I'll explain a bit. Next week's blog post. I'm not going to put out this week. I'm probably going to put out another update. This is for non-members, of course. Quite a few members have joined my tips list, but you don't need to because I talk about these companies on a weekly basis. And also I will post a blog a week before I send the email tip out to the wider non-member list. So you have a week's notice at least. But it's maybe not the Sunday, but the Sunday after is going to be manually, because I think it's it's going into a pre-tax profit from a loss pretty much. And of course, their market's been artificially suppressed by COVID and the government suppressing administrations. But now, business administration's at an all-time high, 30-year high, and they are very busy. And they're going back into into profit, and so they've gone from, it's a bit of a perfect storm against, massive headwinds against them. Now huge tailwinds, because even companies that were held up or propped up during COVID are going through. Plus, you have the normal amount of companies going through. Plus, you have interest rates, inflation, all that stuff that affected lots of companies. So it's a super busy period for them. And like I said, pre-COVID, they had like I think some margins around about 20-odd%. I mean, net margins. So cash drops the bottom line. It's very chunky revenue, but anyway, I'll do that. I'll update that. What's for Crdl? I want to whittle down the amount of companies on the MicroCap League. They're not all good. I mean, we should be looking at companies that are, maybe recovery plays, good businesses, and exceptional businesses. If they fall into those three, then we should, put them on the list. If they're average, maybe they've been oversold and maybe do a technical bounce. That's not the kind of company I want to look at. I want to look at good businesses or exceptional businesses. Okay. Before I start, no, you're fine there. No questions. That's it. Okay. Oh, what's on there? My holdings. Do you know what? Literally, last week, this was all pretty much. Well, I like a few in the red, but it's many more now in the red after the sell-off last week. I do think we're heading into. I mean, even with volatility, I heard a stat this week saying apparently in a year the S&P 500 will correct.
Yeah.
Sorry, someone's got their mic on. The S&P 500 will correct about 3 times, so around about 5% drops, and it's only happened twice this year. So it can happen. These kind of things can happen. Anyway, so biggest holdings, Beeks. I said on the blog, I have topped up on that. I do see that as an exceptional business potentially. Cambridge is now up, and maybe a recovery play. Celebris is up, and Iraq down. I've only got 1.22% of my portfolio value in these. The only exception here where I've gone a bit bigger is Ramsdens, and I explain why in a bit. I did get back into sectors. It tripped out on that spike down. And I did explain, I sort of averaged up too quickly there. My margin of profit wasn't as big as I'd like to be, holding 7% of a company. I wanted to be at least 20%. So I averaged up all wrong. But I'm back in there because it's a great business. It's growing, it's good value, skin in the game from the CEO, and the end markets are improving. And I thought, I want to be invested in good business. I do explain in the blog anyway. It gutted me that it took me out. I mean, I made money on it, but not as much as I wanted to make. And so I think now it's still very good value. I like it a lot. Look at this. So I got some money in bonds and ETFs and money market fund. The money market fund is down 0.25%, but they pay a dividend apparently end of this month. So that should help. And these are only temporary things. I do see bond prices rising. I mean, let's be honest now, we are, headed towards lower interest rates. And that means bond prices will go up. Very little doubt. I'd be very surprised if Jerome Powell, head of the Fed, doesn't reduce interest rates, in September, because there was calls for an emergency rate reduction, which is, I don't know where that came from. It's ridiculous. That would put more panic into the market if he came out and said, "Oh, we'll bring interest down." You can't just have someone jumping in because the markets are wobbling. I know people talk about the carry trade. I don't know how big the carry trade is. I mean, I heard figures like 20 billion. That's what it is. That's not big, is it, compared to the rest of the world? So I don't know how it wobbled the market. Anyway, so there we are. That you can see there. My idea is to keep the big chunks. If they're in red, they shouldn't be a big chunk. This is the money market fund. It's only 0.25% down. So, it's nothing to worry about. And as I said, I'll be paid interest on that this month. So that should go back into the blue. It's just, while I'm holding cash, everyone's sitting there with return on the cash. May as well just get some return on it. So bonds and fund. Yes, there we are. 7 in profit, 26% weighting. And companies like 5%, 5 losers, 5.7%. And that's my risk on the companies. They all, trip out on my stop losses. That's what I'll lose off my portfolio, 1.47%. So trying to keep my risk low. The breakdown there. Equities 31, funds 9, money market 12, bonds 36, cash 14. There we are. Okay. All right. Why I've increased my stake in Ramsdens? Like, generally I start off between 1% and 3%, but sometimes you research a company and you get a gut feeling thinking, I think this is going to go higher. Like it. It's good value. It's good, and I think there's not that much risk on the table, to be honest. And I think the reward is more skewed to the upside than the risk is the downside. So they announced a trading update. This is for the full year. And they said positive trading momentum continues in the second half. Full year profit before tax expected to be at least. And I suspect they say that. It's probably going to be a little bit more. Why would they say at least? Which is ahead of expectations. That's always nice to see. They're doing something right. The business is going well. That's a record, profit before tax. And last year, they did a record profit before tax as well, 10.1 million. So when a company starts breaking records like that on a profitable basis, they're doing something right, So here are the next thing. There's 10 points, and I put this on the blog as well, but I thought I'd explain a bit more. I'm not going to go through the whole sort of blog post here, but 10 reasons the investment rationale and why I like this. Growth, in 2023, 27%, net profits to 18%. Value, their PE of 8, EV/EBITDA of 4. So even though they're growing, they're also good value. And I said before, this is very rare because companies that are growing normally, the value is priced in. The expected profits ahead of time is priced in, and it's not here. I think, is there something wrong? What's going on here? But I keep expecting them to come out with a dud update, and they don't. I don't know if there's someone trickling stock into the market or what, because I do think this is a bit of a gift at this level. I really do. They're efficient. Operating margins 13%. This is for a sort of semi-retail online business. Return on capital employed 19%. That's cracking. Now, on the MicroCap League, anything above 10 scores top marks. They're at 19, almost double that. Experienced management team. They bought, it was management buyout, and so Peter Kenyon and the management guy bought this out, and so Peter Kenyon still holds about 3.6% stock, which is it's good. He knows the business inside out. That's why he bought it. And it's a low risk proven model. They're not. If you look at other businesses, and when they have to expand or into they're not they're not going to new markets. They're going to different parts of Britain, and the good thing is they're expanding down south. Now, if you look at the sales per person in H&T stores, which is their peer group, they're a lot higher. So they're going to now a more prosperous area where their pawnbroking side of the business will improve. People take out bigger loans down the south. I mean, it's the north-south divide. It's generally there's more money down south there. So and that's been the case with H&T. H&T's sales per person and loans per customer are a lot higher. That's where they're expanding. The cash generator broken two records there, one after another. Income 5% dividend, and they're increasing that. At the interims, they increased their interim dividend by 9%. And in fact, I think it's about 5.25% already. So you're getting paid to hold shares here, and it's in a range. That's what I like. I've said before, try avoid ranges unless you're getting paid a dividend. If it's a very defined range, and this is a profit generating company. Now it's different. Most obviously loss making companies don't pay dividends, but when they're paying a dividend and it's generating cash, then assets are growing. So the longer they stay in that range for and they're getting paid to hold, the better, because the assets are growing. So end market's positive. Gold, pawnbroking, currency effects doing well. There's record numbers of people going on holidays because of the crap weather here. That will help their currency effects side. Luxury watches was the only dodgy area. That's now stabilized, and also the Watches of Switzerland said that as well. Pawnbroking is growing at a nice click, and that's very good income. But gold, exceptional. Gold is not coming down. I've been looking at the charts of gold, and this is the blue here is interest rates, right? And you see when it peaks out, gold really starts to rise, and it sort of crosses over here. And these are interest rates going from 3 to 0% pretty much. And this is 2004, 2024. And you can see once they cross, they really start to motor. Now we're right now, we're at 5%, this is 2023, 5%, and interest rates coming down. You can see this crossing. I see gold continuing to rally, as they debase, sort of weaken the dollar, and it's all about the dollar. And so there's a start of a look at this. Started reducing interest rates in 2007, and it motored on for for years. Then had a bowl, then motored on again, and so I see this being gold bull markets the last few years, and so I don't see gold ever selling off now. We're not in a more certain environment, so gold will be strong for a long time. So I can still see that doing well. Cost of living crisis. Also, if America's in a recession, and I don't know if you heard it stat, $1 in $7 in the world, 1 in 7 of any currency basically, spent in the world is spent by American people. So it's a huge economy. There's a cost of living crisis in this country. Interest rates are not coming down very quickly. So there's still a struggling, class of people out there looking for money. Pawnbroking will always do well. And then you've got, jewelry bought and sold. I think it's a very well diversified model. They've also launched these websites dedicated, to online proposition, and rapid expansion. 9 to 12 stores per year. It's literally, they know what they're doing. They've got 167 or 170 stores now. It's nothing new to them. All they have to find is locations. They've scouted out many locations that are ideal. They say there's plenty of towns in the country to support 300 stores. And they're at 160. So they can continue for a long, long time. And like I said, it's a well-refined operation. It's no big risk here. And if you look at this, last year's full year results, Ramsdens generate 83 million or 84 million in revenue, with pre-tax profits of 10.1 on 160 stores. Now, basic maths will tell you, of course, some stores are mature, others are not. But if you do the basic maths, each store generates about 500,000, in revenue and 663,000 in pre-tax profit per year. That's 12% margin. It works out. If you put that against their final results, it does scan. If Ramsdens are adding 10 stores a year, this equates to an extra 5 million top line revenue and 6 million in pre-tax profit per year. That's not including the stores they already have out there. This is the new stores. So you're pretty much adding this every year without adding efficiencies and scale, without how they're improving the current stores. That's just been added every year. And so, within 4 years, they should have approximately 200 stores, generating over 100 million in revenue, 12 million pre-tax profit. That's an EV/EBITDA of 3, pretty much, and a PE of 5. That is too cheap for a company this efficient, growing this well, paying that kind of dividend. This is the kind of business you want to own a share in, or I do, even if it wasn't listed. You think, would you like a business like this? Yes, I would. The end markets are never going to die, really. The really big worry is if gold collapses. It's one quarter of the business, pretty much, but gold isn't going to collapse. It's not going to collapse. Not now, interest rates coming down. It's like, and gold doesn't often collapse. And this is what I like. I will buy more of this. I'm at just over 5%. When it breaks that range, I'll buy more. I'm half tempted to just top up even more now, because I think that the bottom of the range is defined. In fact, let's look at the chart here. Where's the chart? Let's scroll in. So you often get this. You often get these sort of, when you get a sort of bull market or a rally like that, a rally, you'll have a pullback. And then, like I said, you get a range. You get a consolidation and a range. And this is where the bulls and bears sort of fighting. Lower liquidity is rising there. And right now, we are in this range, which it shows you get a, overbought system time here. Then you get the big sell-off, comes back down, and oversold. And then in between that, you find this sort of, equilibrium, a sort of range where it'll comfortably trade in between. And it can be in this for a long time. And like right now, it's, the maximum it hits is 210. It's constantly done that. They release a trading update and some sellers come in at 210 and start selling or taking some profit here.
Justin, you're not sharing.
Oh, sorry. Did I share any of that then? Oh, hang on.
I can see it.
No, you didn't.
Oh. Can anyone see or not? Can anyone else see?
We can see it, Justin.
Oh. David, apparently I'm sharing. Yeah, it's on share here.
Just me then.
Oh, hang on.
What's going on?
Yeah, yeah, yeah. I know, but if you look at, I mean, David, you're good there. So first of all, Darren says, "What's your opinion on the large number of companies delisting from AIM?" Good. They're all crap. Most of the companies delisting are rubbish, and what they do is just drag the performance of the AIM all share down. And so we need to get rid of the rubbish. Honestly, it's the good companies. Name a good profitable company. I don't think there's many that are delisting from AIM. They don't. It's generally pre-revenue loss-making companies that can't raise money. And so that's why they're delisting. So I don't think it's, I mean, which companies are you talking about? Because all I can think of is biotech stocks that are cash burners that can't raise money. It's a natural progression of the market. When you're in the bear market, you have this. And you'll find when a bull market starts, then a lot more companies will list and pre-revenue loss-making stocks, and it'll fill the market back up with crap again. But I think it's good to have a fewer amount of higher quality businesses than lots of trash. So I see a lot of people on Twitter whinging about this. I think these companies, they're never going to make money. The reason why they come to AIM is to raise money to grow and start making a profit and return money to shareholders. Okay, in a bull market, you can say the share price does go up and returns money if people sell, but that's not the point. It's these companies. And I mean, correct me if I'm wrong, but are there any companies? I'm not aware of any companies that are actually, generating money, generating cash, and are have left really. Apart from they've moved the big companies gone to America because most of the market's in America, but I don't know to be that. RFX low rating standard. Yeah, but if you go back there, David, and look at the share price, on the rise there, the rating is a lot higher. I believe they will get a re-rating. We're in a range now. It'll break that. It'll go higher. I mean, because when you're talking a PE, literally sub 8, and it's they're generating cash and their profits are going up, it will re-rate. Have a look around. I mean, even I did look at in fact we'll look at it later, but Venture Life Group. I don't see why that's anywhere near Ramsdens valuation, because right. Anyway, yeah, maybe it's a slow burn, but you keep rolling stores out at a profit. In the end, you can't ignore it. When you are paying it, 5% dividend, and it'll trade in the range for a while. I'm confident. If they continue to turn out good figures, it'll go higher. We can talk about the markets. You can speculate about markets a lot, but when you have a high gold price, you've got more people coming through the stores. They tend to be look for other things as well, and so it's a good driver of everything. But I just think it's a very good business model. What's the last 5 years? Store growth for the last 5 years. What they've done. I mean, if you look on, I think they've done compound annual growth of I don't know. I have a look at it. I can see it, Peters. I can see it. I can see it. Fine. Okay. What stops Hat squeezing them? Well, no, because it's like bookies, H&T, by the way. I mean, if you read the thing, H&T are largely skewed towards pawnbroking, and it's a little bit of a different business model. They're more based on their book. Ramsdens have better margins. They're more efficient and less debt. It's one of the things I have confidence in. And very rarely is, I've gone big sometimes and got it wrong, but I'm not big on this yet. Just 25%. But I do see this dipping, just moving that range. And if it does close up here, like I said, it keeps breaking this. To make sure it does close above this, I'll definitely buy bigger on 212 as an alert there. I'll keep holding for a 5% dividend. And I just think it'll, if this is now over 3 months being this range for, it won't stay this for a while. I honestly believe it'll break the higher range. And, the best thing you can do really is literally put an alert on that, and 212, I'll probably double my holding on it, I think. Because it is one of the things I keep thinking, I'm looking around at other companies, just looking around thinking, I don't understand this. Am I missing something? And I remember doing that before when it was like, what was it? Oh, Good Energy was at that. They were below the net asset value. They don't. I thought, why is this? And I kept down to myself down here, and I sort of bought down here. And I thought, it's below net assets. They've got a ton of cash. They're in a growing sector of the market. And I thought, have I got something wrong here? And you realize it's not that. It's just, it takes a while sometimes for the penny to drop on many people and it just shoots up. I mean, the trouble with Good Energy there was that it's a large, unfriendly shareholder. And so it's very volatile stock because there's not a lot in float. So you get, and they did this acquisition, it sold off. But I think it'll happen again with this. It'll trade in a range for a while, but definitely Ramsdens, honestly. I'd be surprised if I don't know how long this range will last, but sooner or later I believe it'll break it because their assets are growing, the profits are growing, they're returning money to shareholders. I don't see why I wouldn't go above that when they're on a low rate like this. It's a lot more efficient than H&T and not smaller. In fact, I wouldn't be surprised if H&T make try and make them a target. Maybe they couldn't afford them. Just an opinion. I sometimes I literally, I was thinking yesterday, I thought, I'm just going to buy more of this because it's going to break up and I want to be in a nice position when it does. And just to me, that says when you come down here on a big sell-off and it hits the bottom and then it trains at a range, that's a good sign. So it's a nice defined range here. I'd be surprised if it breaks down below this again. But I'm happy to hold on 5% while I'm picking up a dividend. Anyway, that's enough rubbish for me. RFX EPS growth year end is only hat forecast. We'll see. They'll trade the same. They both break out. I mean, if you look at the do you know what? I haven't really. I looked at the hats. I've read the broken notes on them basically, but I'll go through and put hat on the no. Hang on a sec. Listen, the difference is they were saying that hat as well. Read the broker note. They're saying it's really hard to value hat's pawnbroker. They never say how many bad loans go through and all this stuff. So it's covered up a little bit, but it's David's not convinced to do it 250 because it's had a lot less shops. So they're putting on 10 shops a year. So do you understand that 10 shops a year, they're adding 5 million in revenue every year, adding over 500,000 in net profit a year, pretty much.
But didn't you say they're loss making for 3 years or so?
Who?
The new stores.
No, they're loss making for year 2 and year 3. I think, well, if you look at the thing, it's operating loss or fully profitable by year 3. Yeah, but they're putting 10 stores on a year. So you understand the maturity of these get better. And as they, you imagine the financial burden of adding 10 stores when you have 200 stores is less than when you have 100 stores, 150 stores. So, the economics work out very well the more stores you add because it's less of a financial burden if they start becoming profitable after you. I mean, honestly, I just think as a risk reward play, it's not going to blow the doors off, But I see what's the broker target, 50% up or something. I see it very achievable, 50%, and very low risk, 50%. Yeah, so that's what I'm saying. It's like they are adding 10 stores a year. Even if impact between 9 and 12, they say. But there we are. So and they've been doing that for a while. Anyway, okay, let's move on. Let's we'll look at what's it called? Watch this Jneo. So sorry, I'm going to look at Journeo because someone did ask me to look at Journeo last week, and I forgot. That annoyed me. That tripped out. Big seller in there. I didn't have a lot in it, but I didn't really buy it very well actually. The level at, but of course, remember, if we all choose to get rid of one of these companies, they come off the MicroCap League because I want to, a shorter list of companies that I can literally, know very well and update them very well. And we know there's not dogs in there because there's quite a lot of dogs in there that probably never ever generate any cash or be profitable. So I want to get them to a list of companies. I don't know how many that is, probably, but maybe half the size of the list right now, where we know them, get to know them very well. Because sometimes, opportunities lying under your nose, and you're not aware of them because we haven't researched them. We touched on them, but it'd be nice to research them more. Okay. So the first one is Cordel. I think what did they come up with some news this week on a contract renewal? But I did sort of like this company at the start. Let me pump this up so you can see it. Cordel. Right there. So they are, and they've got these sort of AI, mass data management systems. So they use these. I've seen them. And to be fair, this company talked about AI a while back. I don't, I remember when they first listed, or they changed their name actually. I interviewed the guy once, but they look at train tracks and all that stuff, and anything to do with things. And even when a train's traveling at 90 miles an hour, this can analyze the tracks, see any, malfunctions or imperfections or errors or damages to the track. And, it's a lot faster and it's a lot safer as well. And so the idea is quite nice. Now, look at the broker target there. They're 4 pence a share. Target price 22 pence. That's 450%. I don't understand that target, to be honest. I do understand they've got some nice contracts with Amtrak and stuff. So their market cap is only 8, so a tiddler. One of these kind of companies that can rise on a bit of hype. Enterprise value 7.3. Yeah, and so if you look at the scores here, growth is good, but value is questionable. Momentum's not there. Potential is huge, like there's broken target there. Efficiency, yeah, well, it's not profitable, but health is okay. So they made an operating loss. In fact, let's look at the 6 months, but the 12 months to June last year, operating loss of 858. Revenue of 3 million, and they got cash of 1.2. So you could say pretty much going off that, they pretty much got enough for a year. Where are we now? June. Yeah, okay, we've gone past June. So how much cash they got? Let's have a look if they got raising cash. I don't think they have actually raising cash. How much they need? Crdl. Cordel. So US, this is with Amtrak. So it's extension with Amtrak's. Oh, yeah, North American corridor. It doesn't actually say how much it is, but let's just check if they've business and trading update. That's it. So I've uploaded the broker note. So 4.4 million top line is nice, growing nicely. Closing cash. Oh, there we are. So they haven't lost a lot, have they? Closing cash, unless they placed. Only they've lost what? 260,000. That's less than that. November. There we are. Hang on. So new Middle East, they haven't raised any money. So I do sort of like the idea of this company. It's just, anyway. So look at that, 108% growth in trims. Very good. Value is 2 times. It's not too bad in terms of sales if it's growing that fast. EBITDA is minus. Like I said, they're 1.1 there. Not there. In fact, 1.1. So from the half year, it's not too bad. Current ratio is good. All healthy. Top line, yes, gross margins are fine. Broker targets there, or they have dipped down. So if we look at this, 9.5. So yeah, 8. Look at the forecast here. Just update the forecast. Now, I've added 2026 because there's no forecast 2026. And the brokers just got 2024. And literally, for next year, they put the 0 in there. I can't put a 0 because it messes all the figures up. So per pound, and I've just raised about 200,000 there. So assuming they go then positive then after that. So as yet, even the top line is good. I'm just guessing on the margins here. All right. Like I said, as yet, we don't really know how far out, but then they're going to be making a loss this year of around about 700 grand, 732. And the next year breaking even, pretty much EBITDA profitable, and 0 on profit before tax, and hopefully profitable in the year after. Let's look at the chart. The fact that they got contracts with Amtrak, which is it's quite big, isn't it, America? So it's come down, and it's where's the 200 day? Oh, there it is. It's trying to get above that. But what are we thinking? This is a hope stock, or look at that. I do like it's done that before, but it's really flattened out the 200-day moving average. Yeah. Yeah. Anyway, what's your thoughts, ladies and gentlemen of the jury? What's your thoughts? Cordel, shall we leave it on the MicroCap League, or shall we take it off? Remove Cordel from the list. Very low volumes. If we all bought K of the stock, we'd impact the stock price. Still loss making. Yeah, I wouldn't get rid of it on volume alone though, because companies can go from having no volume to massive volume if it does well. If the share price rises, the volume improves. But it is still loss making. But to me, like the tech, it's AI and it can work at 90 miles an hour. This was a company I said doing AI before it was really popular to mention AI. Keep expanded Amtrak deal. Lots of investment in rail in the US and Europe. That's a good point, actually. Yeah. It's small, but winning contracts. Keep. Tim says too small. Too illiquid for Alan. Remove. Keep. USA big market, says Tim. Michael says no entry, which I mean, or delete. Go rid. I stick on the watch list, but without an option to remove for now. Yeah. Looks like micro company. It is a micro company. But remember, these kind of companies can, if they land a massive contract, it'll go like crazy, and that could change the whole profit profile of this company. The fact is winning contracts, I do quite like. For me, like I said, it's not quite profitable, but I don't think they need cash, so they're getting there. So do you know what? The fact that I'm on the fence about it means that we keep it. I'll watch it because we keep it there. Because to me, it's not a bum company that's going nowhere. It's literally. I like where they are, I like the sector they're in. They're winning contracts. Amtrak is one of the biggest operators in rail in America, and I think that kind of validation of contracts. I mean, big companies like that don't go with crap companies with crap tech. They've got to have something. So I think it interests me. It does interest me. So maybe I'm going to watch it. Okay, we'll keep it on. I need to be more ruthless in this, but never mind. Okay, so we're not all convinced. Some say remove, but let's just keep it on. It's interesting. It's more interesting than a lot of stocks, I can see out there. Journeo. So sorry, I didn't cover this last week. I did like Journeo, but you know what? I bought this on fear of missing out a little bit last time because I was monitoring this and liked the company. And I don't know why I didn't hit the buy button back when I should have. Sorry, my internet's a bit slow here. Why isn't the chart loading? Oh, there. This is where, and in fact, this here, right? This is the kind of thing, this is an uptrend here. It's the kind of thing, a range where people just lose faith in. And the sellers dry up. In fact, a range like Ramsdens range. People just lose faith, just goes in a range for ages. Keeps trying to break that. Look at that. How long will this last? And I was watching this for ages, and they kept landing contracts after contracts after contracts. And I was just watching it. I didn't really hit the buy button. And then literally 140, convincingly broke above 140 on the 23rd of March, 2023. It never closed above that in what? How many years? Since 2021 to 2023. 2 years. It was in a range for, but they weren't paying a dividend. 2 years. And then it did it. Look at that. So sometimes even there, it went up to 154 here. But it came back down. So you need to look at closes. When you get a powerful break above a close and it closes above previous levels, that's a good sign. Why? Because sellers haven't come in. It either means the volume's gone up and basically over it's like a wave, drowned out the sellers, or the sellers have dried up and also volume's increased. But they were releasing contracts for a long time, and I was watching that. And then they went from 140, really get on my nerves. Oh, I quite like that company. And what I liked about it is that they've got hardware and software. So they sell the hardware up front, nice contract money up front, then recurring revenue software. Synaptics is doing that. So actually Synaptics are better margin-wise, I think, a better place in this company. And anyway, in fact, and they're starting to get recurring revenue. But I sort of got in, I think, was it here? I don't know, where it dipped somewhere. And I literally, it was because I missed out on here. I was so pissed off I missed out. I bought into it too late, really, too late in the market. So anyway, Jneo, so we know what they sort of do. Like I said, they do it in travel. All these display boards you see when, at the bus stop, the LEDs, or, the software behind that sorts them out, telling you when the next bus or train's arriving, all that kind of stuff. And of course, they update that with software is going. So the hardware and the software. Where are they? Journeo are they are 16 on the MicroCap League. In fact, the brokers have just updated them this week to 470. Intelligent transport system provider. So market cap 44 million, enterprise value 36. So they've got more cash than and debt, of course. Volume is good there. Revenue 46 million. So 1-to-1 sales EV, nice. Operating profit 3.9, cash 8.1, a little bit of debt, operating cash flow. So they got all this value, maybe questionable, or momentum. In fact, momentum's better now, but they just big seller came in. I think was it Mighton Trust? I think Premier Mighton was selling that. I think just took it out. But 30, it's all good. So 30 versus 12, top scores on all growth metrics. Now I've got a value, it's just above one, so it's not top spot, but PE of 15, price to book through, so EBITDA 7. So it's not convincing on the metrics, but if it's going forward, then if there's growth going forward, then hopefully that will improve. Cash, it's all good. Efficiency, a little bit questionable because they do hardware, which Synectis do as well, but their margins are above 40. So yeah, I mean, return on capital is good, but operating margins, and gross margins a bit low. I've been considering getting, topping up on Billington, but their next year's revenue and profits are dropping a little bit, but they're still good value. But you realize what impact will it have, Billington, when they release results and even top line has dropped, but they're still good value. And I think they'll fall a little bit. So I'm waiting. Billington is a good company, but margins. The reason why I say that is their margins aren't that good, but the return on capital is very good. Billington, and I think. But anyway, so here we go. This is the thing. So very good growth last year. They did an acquisition that was amazing, apparently, and it's taken them up. But going forward, if you look at this, a forecast, so not, it's 118%, because of this acquisition. And then it's literally, it's okay, 8%, 4%. So that's, it's not huge growth from here. But nevertheless, the margins are okay. In fact, net margin of 8%, fine. And not bad value, But, will people see this as, the X growth now? That's it. I don't know. But I don't see, if you give it like literally 1 time sales, 10 times EBITDA, 15 PE, you only get into a 40%. Well, that's fine. 39, 40%, that's fine. That it's fine. But it's not what the brokers give it, 74%. So anyway, so we are. Yeah, look at that. Jump down back to, it'd be interesting to see. Look at that. That there's a series there, unless they can get above that. You can see that it's a series. I don't want a dotted line. I want a line. No messing around. That's several series of lower highs now, isn't it? They need to break that really. Yeah. So it was rolling over a little bit. There we are. Anyway, Journeo. Like it or not, Steve, tick on the watch list. Is this for Journeo? Journeo keep, David says. Steve, but that's okay. Journeo keep on the watch list. Pete, okay. Journeo keep for the journey. Hey, and it says steady, well-managed growth, clever acquisitions. Premier Mighton sold out. They have lost a contract in New York as Subway has fewer commuters. They have cash. Only worries Rick Reeves wants the fat controller. Wants to be the fat controller, you mean? Definitely keep, will probably get acquired. Yeah, it's worth watching. I think this kind of company, if it has a sell-off like that, that's really where I should have bought on the sell-off a little when it rebounded a bit. Because it does happen. You can see this week, there's great companies like, Biggs, for example. It's there are great companies, I think, great businesses and exceptional ones. I think Ramsdens is a great business and it can return a nice return over time, steady, building profit, tried and tested model, good margins. Beeks is potentially exceptional, but there are very few great businesses out there on AIM. Okay, in the country actually, that's the whole thing. By definition, there can't be many exceptional businesses, otherwise they wouldn't be exceptional. And also great businesses, the majority average, maybe a bit average or below average. But you're looking for great and exceptional. There are very few exceptionals. There are a few more greats. But Journeo seems like a great business. It really does. And when you see a great business sold off, or exceptional one sold off in a global sell-off, and it does. The thing is, that's the market. It does happen more often than you think. Twice a year, maybe even 3 times a year, you get a bit of a sell-off. That's when you sit on the sidelines and thinking, right, I'm gonna jump in now. Like people, but it's funny. It's the thing, isn't it? You get scared by the market. I did, buy some beaks, like I said, on a blog when it dipped down because I didn't think it would keep going up. I didn't think it'd come back down, but you see that I did top up. But like I say, when there's a sale on the stock market, people run away. When there's a sale in the shops, people run into the shop and buy. But sometimes you have to, jump into great businesses or top up when there's a big sell-off like that, because it's a bit of an opportunity, I think. Same as yourself, looked at this company for ages and should have bought, just never did. Keep, very nice company. Yeah, it's a nice company. Keep, Tim says. Yeah. They don't fit the criteria. No, they don't. They're a good business. Keep. They should buy Cordel easily. Yeah, they could buy. Yeah, Mike. So Michael's a man of very few words. Literally cross button or why. TrueFin now 2 million. Yeah, Darren. TrueFin now sales since recent laws. Has anyone found out what 2 million users mean revenue? Yeah, listen. I look for the broker note because they did explain. I think if you look at the broker note, they explain the revenue breakdown. And it's something like you get money going to the publisher, of course, and then there's costs and all that stuff. And I think they end up it's about 30%, something like that, or less than that. Have a look in the broker note. If you want to get a broker note, just click on target. I'll show you. Hang on. Yeah, let's have a quick look. Let's have a quick look. Yeah, it's almost like saying, it is patience, isn't it? When a company does rise and fear of missing out, you're guaranteed once, twice a year, a general sell-off, and those businesses go on sale for a few days. That's when you jump in because, listen, there's no news out. There was negative about those companies. It was just the markets. Let's TrueFin. Let's say. TrueFin.
What's running? Who's running?
Who's running? Who is running? Oh, I'm missing the thing. 10 minutes left. I think it's there anyway. Have a look. Okay. I think it's there in the broker note. They say how much they get. Oh, hello. I thought I was a naked lady. My internet is rubbish. All my kids are on the internet, and we've moved to this new house, and I'm waiting for super fiber to come in, and they haven't got it. So anyway, but yeah, positive trading setting off. Oh, hang on, what was that? What happened there? Journeo. How did they go back to that? Okay, National World. This is something Mr. Staveley's invested in. Essentially, they're like buying up all the regional newspapers and the digital sites and cutting costs. I thought, I can see it as a recovery play, but it's just thinking less and less people are. There's so much competition online, isn't there? For they are number 40, were they? A based media company. The company's principal activity is to operate news publishing sector. The company provides news and information services in the UK. I just think this is a dying. Is it dying, this sector? Just traditional news outlets. I mean, if you look at my kids, they don't even watch live TV. Definitely don't watch newspapers, not even online. My wife's gone to sort of online, reading papers online. But now my kids never look at the online newspapers. David, I think you're on, your mic's on. You say, oh my God, you're shouting. Oh, hang on, is that right? That may be wrong, but they are 43 million. Enterprise value 32. Let's look. 2.6 operating cash flow or profit. 4.4, free cash flow minus 12.9. But these are results for for June. You can see they've improved a lot the half year, a lot more green here. Value there, they're on decent value. PE of 20, the margin's quite low. EBITDA is fine. Health is fine, 13 million. Cash has gone up. It's all looking good. That broker target's wrong. I'm sure that's wrong. Let's have a look. What is the broker target? So it's the back end. But anyway, they operate in the news area, and I understand Richard Staveley and is it Rockwood, Street Rockwood, or whatever they're called. He's bought a chunk in them. I think okay, you can see a turnaround happening here, but it's not not so look at the forward forecast here. So 100 million top line. What are their market cap? Yeah, 40 or 32 EV. So 100 million. Like the margins here were 27 gross margin, 11. Well, that's not too bad. They're saying 10% net margin. Really? No, that's what the brokers are saying. I don't believe that really. Or they do adjusted margins, which I think, why are you doing adjusted margins for? I want reported figures if we come out. So I tend not to believe that. But if you put them on a PE of 0.5, which it's above where they are now, and EV/EBITDA 5, 10, then you do get upside. You do get upside in this company if they achieve those, but that's based on those margins. Be careful. What is going on my computer? There we are. It's a bit of a. It is. So you can see it's coming down from a long way. Where did IPO up here? In 2021 with the bull market, come all the way down from what 25 pence, and now sort of half that. It did go to half that, 12 pence there. It's at 16 now. It's above 200 a day. But is it worth keeping? Turn around here. But what do you reckon? Is it, ladies and gentlemen, National World? What do you reckon? Tim, get rid. Sorry, that's my son scaring the crap out of me. Okay. What did he do? Who's running, you said? What was the story there? Were you watching the Olympics or was it something else? Drop them from the list. Yeah, 30 pence. Or 30 pence to target. Is it? Not for me, but options available. Is there a future in news? Exactly, Nigel. That's what I think. I think it's dying breed. It's one of the things where it may take a while. They may get efficiencies. There's online advertising, isn't there? But you've got to be. It's not about being newspapers anymore, is it? It's got to be about best content online. Now, if you can afford to employ good journalists that can get that content out there, then you win. You win the eyeballs from the search engines. But again, these days, Rockwood, pretty smart though. Yeah, fish and chip paper. Looks like no. Yeah, but Rockwood's they tend to go with the higher risks. They do a lot more research. Like a Capita. What was the other one? Trifast, and they are quite boring old worldly businesses. Some of them, aren't they? I mean, Filtronic, they've got a good name from that. But yeah, sweating the assets. That's what they do. I know. But luckily they can have some big winners and some losers. But yeah. So anyway, National World gone. It's not. I'm not going to invest in that in newspapers. No way. Okay. What's next? Sanderson Design. So they come up with an operating update, and of course they are in. We know what they're in, but they're in luxury furnishings, all that stuff. They've got. I think deals next, haven't they? And quite posh wallpaper, all that kind of fabrics, all that. And they've got licensing deals in America with quite a few big companies. I do like the company because they have very good margins, very well run, but you can tell we're in a cost of living crisis. A couple of profit warnings coming out. There we are. They come up with results soon. 62 on the market. But it's all green here. They're healthy. They're very healthy here. 120. The broker sees 42% upside. Market cap 59. Enterprise value 43. Look at that. Net assets 121. I do quite like that. When you've got a profitable company that's at their net assets, pretty much. It may take a while to turn around. But they did say, actually, in the trade update, if you read that, it's worth reading. They did say, they warned about 2 months ago, saying it's going to, the market's getting worse, all that stuff. And they said, it's not now as bad as we thought it was. So they may have seen the worst. So it's getting less worse, but they're still profitable. Like I said, they got cash, 16 million. In fact, that's gone down now to 9 million, they've mentioned. But it's profitable. Like I said, look at the drop here. There's it, after results, yeah. So it's all looking good. Value is good. Health is good. It's fine. It's all fine. Margin's very good. Gross margins is decent. This was previously. There's no momentum here. But this is my thoughts. Like I say, I've just moved house. I realized how much you spend on stuff when you move house. Things you never even planned to spend. That Amazon deliveries every day, DPD coming here just when you're renovating a house. And of course, we are now at a high interest rate environment, in fact, house prices have gone up and sales are improving. But when when real estate or house interest rates start coming down and the market becomes more buoyant, this will benefit from that, of course, because people start doing their houses a lot more. So let's look at the forecast, right? The forecast not taking a huge knock. And the margins they've gone from 108 million, or 111, 108, 104. Apparently 2026 back to growth, a little bit, 3%. But they've got good gross margins. Net margins here were 7, 8%, gone down to 5. The first 2 years of forecast, but nevertheless, they're still checking out pretty net profit forecast of around about, top fives, nearly 6 million. So you can see 6 million on an enterprise value of 43. It's less than 10, isn't it? So if they start growing, I think there may be potential here. Look at the value here going forward. It's nothing, 4 EBITDA. In fact, P still 10 there. It's not as good value as Ramsdens. So yeah, I mean, if you put it on a PE of 0.6, 6 EBITDA 12, then I don't see a lot of upside here. But of course, that can change. These figures can change rapidly, as can the margins, if the market starts improving, if the end market starts improving, which they will do. We know that. It's one of these stocks where you can almost predict what's going to happen. The interest rates are coming down. The property market will pick up. People will be buying more stuff, crap for their houses. So this will benefit. So we know that's going to happen. How long it takes, I don't know. How early do you take a position? If you can take one, I don't know. But at least they just said it's getting less worse out there. So anyway, Sanderson, is it worth keeping on there, or is it worth not? House prices back on the up. Graham says 500k new houses, they should benefit. That's a good point. The targets, the government's always quite bullish on targets, housing targets. They never quite get there. States is a big part of the sales, which could be a worry. Keep on the list. Yeah, oddly, the state, it's the UK they were warning on. The state side of it, licensing was okay, but that may downturn and UK may pick up. Austerity cycle ahead in UK as high taxes impact everyone, which will impact Sanderson's products, in my opinion. So avoid for me. Yeah, I understand what you're saying, but isn't the biggest expenditure for any household pretty much mortgage, and then it's bills, isn't it, I suppose? So if people now can refinance on lower rates, I'm just thinking, and even move. Looks okay to me. Revenue forecast looks too conservative. Yeah, it is quite conservative. That'll change though. If the market changes, that'll change. Still got cash, makes a profit worth keeping. Yeah, SDG watch list. I agree. I think it's a decent company. It's worth putting on the watch list. Where are the chart? Do I look at the chart quickly? Look at the chart. SDG. When you're ready, yeah, look at that. So it's kept in the range there. I'd want us to bottom out smoothly. That's quite nice. It's bounced up off this profit warning. It's come back down, had a little sort of retest, and it's not gone below this area. So pretty much, maybe a little trade between maybe that and that. 92-ish, 92 and 80, It's an early, as yet you can't tell a range because there's not enough time, but that's what it's looking like. So yeah, keep an eye on it. There we are. Okay. SDI Group, not STI Group. Oh, STD Group. I don't know why I thought of that. But let's look at SDI. Do you know this company? They came out with results this week. SDI, they are number 98 Okay, and then up to 98 from 116 last week. So let's have a look at this. They design and manufacture scientific and technology products for use in digital imaging and sensing in control applications, including life sciences, healthcare, astronomy, plastics, packaging, all that stuff. Let's have a quick look at the website to give us an example, a flavor of what we have covered these before, by the way. Clear vision to develop and diversify its existing technologies to grow through strategic acquisitions. More. So that's what they are. Oh, I don't know what it means. Okay. SDI look at that portfolio. Attic cameras, control signature. There's all that. They've got a lot of products. That's the thing that worries me. This kind of stuff. They've got a lot of products, haven't they? I mean, I like a few products because it's not one trick pony. But are they all quite similar though? But when you have lots of products, okay, they do all this kind of stuff, peak sensors, all this. But how are the end markets here? So I'm thinking of sensors, all that stuff. I don't know what the end markets are like here, to be honest. Target 30 pence. I'll update that. Yeah. NW over here. There we are. Put that in there. See, I keep getting that. There's a glitch on that. I put the thing. I keep missing the end thing off. So SDI, here we are. Telling the tape. So they have a market cap of 67, 88. So they got some debt. But the broker sees 107% higher target. Average daily volume, decent, 300,000. Revenue 65 million. Operating profit of 7.2. Cash 1.3. Debt 21 million. For operating cash, so they are profitable. Obviously, the growth here, growth is 14. They do say there's a turnaround happening. They are apparently strategically narrowing down the focus of the company. So these are results for the 30th of April 2024. Revenue went down, but operating profit went up a little bit, as did net profit. Operating cash flow went down, but free cash flow went up. So price of sales, PE 16, price to book, 1.5, EBITDA 10, price to figure 80. Wow. So yeah, questionable. They've got 20 million of debt. Gross gearing is 47, but their margins are good. 63, 11, return on capital 10, it's fine. So margins are good. They're in a downtrend by the looks. So let's have a look what the forecasts are then. So they are doing small top line growth, but it looks like the margins are improving. And they're looking at 10% net margin there, forecast going forward. So the value is quite good. There's not a huge amount of growth here, but putting them on 1.4 sales because the operating margins are 14. So that's how you sort of work it out. You add a bit of growth as well, but 1.4. So you put them a sales multiple of 1.4, 7 EBITDA, 14 there. So yeah, I mean, there's upside there, definitely a little bit of upside. But they've got a bit of debt. They're profitable. Let's look at the chart. In fact, I think I did like the chart, the SDI. There we are. I think it was one of those ones that were forming nicely into like an arrow tick. Was it? Well, they've got a little bit to go yet. But you can see here pretty much, we zoom in, they've come off the low, which was that at 52. And they've rallied to 73. Now at 65. So we've got this, I said, you get these extremes when you hit a low. You go from a low to a high, and it also arranges for settles in between, calms down. But SDI, so they're profitable, they're going to be debt. That's a little bit worrying. What's your thoughts on SDI, ladies and gentlemen? SDI, should we keep them or not? Need some good management to sort out the whole mess of companies. Could be great turnaround from current mediocre performance. 50-50 on this one, Tim. Okay, 50-50 then, unless we convinced it should be struck out. Big debt, if they narrow their offer of the revenue may drop and margin may improve. Keep as recovery play. No, not one for me. Now, watch list. Okay. Yes. Okay. SDI keep. Okay, keep. Okay, Rob. Hello, Rob. What have you been? Phil, watch this. Yes. No, I was thinking that. I think it's a profitable company, and if if you're generating profit, you can chip away at that debt. Now, as interest rates come down, you can refinance the debt, and of course, forward-looking couple of years, you can refinance it at a lower rate. So, yeah, I think it's one to watch a little bit. I'll put an alert on that. Anyway, so I think we're on the last one. Last one. Final hurdle, the final thing. Where are we? Venture Life. I did a podcast there. I did compare this to Ramsdens. It doesn't sound wise to say market cap. They did a trade update, and this company to me, it was at one point undervalued, I believe, but it was like when it was like down here at like 28 pence. I think oh no, it was down here. That's right. It's down here, bounced on the bottom of it. That's not a bad valuation there because it was it's starting to get profitable again. They sort of went backwards. I don't know what happened to them. They sort of went backwards and then they weren't as convincing. Their fundamentals went back. So I mean, Venture Life, but they are number 11. 56 million, 75 million. Okay, now EBITDA, so got debt. The broker says 51% upside. Revenue 51, operating profit 3, cash thing 24, debt 24 million debt, operating cash flow 2. So they are generating some cash, and it's looking all quite good here. But then, where are half-year results? What do they say? There's a trading update that came out that was flat, basically, and I thought, no, that's not that good. Venture Live, let's see the trade update. There we are. So group revenues for the half year, 23.5, same. There we are. And they say cash and debt. They brought the cash debt down by 10.7. Group leverage there. They say wait to the second half, but their forecasts looking forward. What was it? Something like scroll down. Oh, sorry, I've got it on the wrong screen. Yeah, so that yeah, look at that, 2%, 1%. So they are improving. They're looking at, so the growth isn't huge. Well, in fact, 6, 8, 9, fine. Gross margins are fine. 21, 22, EBITDA. So it looks okay, 8, 9. I just think, yeah, I don't know. Yeah, values are okay looking forward, going forward. But like I say, if you put, sales of 1.2, 6 EBITDA, 9 PE, because that's where we're sort of at. Then I see 27% upside. Don't see a huge amount. The brokers have 51%. They are the brokers, though. They've got to be a little bit bullish. But the chart is that was the news. Didn't settle very well. Anyway, that's it. Venture Life. What do you think? Should we leave it on, take it off? Let's be ruthless, yeah. Phil, watch list, growth sector for sale, growth, not really growth company, so not for me. They are focusing on their private brands, which are growing. Broker 55 million, we require growth from 0 to 40%, 82. That's a big ask. Good point, Graham, yes. They want to be on an acquisition trail, but it seems to me they are acquiring just lots of products, old brands, and I don't know if it's a good business model. It's ladies' intimate health and oral health and all that stuff. I'm just thinking, when we're thinking about, we're looking for great businesses or exceptional ones. And I think, is this a great business? They're just cobbling together lots of different brands in healthcare. Yeah, and now might be a great time to buy following its price drop. I wouldn't buy it now. Yes, I couldn't. What would you say to someone? If you had to convince someone this was a good buy, what would you say? Oh, they got lots of good products like stuff you never heard of, like intimate female healthcare and bad breath stuff. Where's I mean, there's huge competition in those markets, isn't it? From really big players, So I'm just thinking, I don't get it. I don't get it. It's not, anyway, I'm not convinced. But unless you want us to keep it on, I'll take it off because I just think it's not going to be exceptional. It may come down to the bottom there and be good value at one point, but I don't think it's an exceptional business or great business in any way whatsoever, really. Anyway, that's it for the thing. So the podcast webinar. It's nice to have you. I'm feeling better sorts this week because I've had builders banging around all day. And literally at one point I had to go for a walk the dog for an hour and a half because I was doing my brain in, just banging all day. But thank you for tuning in, and hopefully I'll be on better form next week. And if I do update, if I do buy or sell anything, I'll put it on the blog. But thanks for joining me, and speak to you next week. Bye 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 bye.